All right, Sridhar Sivaram joins us now, represents Enam Holdings. Sridhar, good morning. Thank you for joining us. They say that good news and good price rarely comes together. Right now, news is terrible and horrible. Have prices become good?
Nikunj, we are flat for the year. So I don't think the prices are as great as the news is making, as we're making out the news to be. So at least my broad view would be that 2022 is a tough year. Protect your capital. Be in stocks where you are sure about the earnings. Concept stocks and price to sales and some other random multiples can be avoided. Finally, it's going to be the earnings that will protect the stock, and even that may actually not help the stock, but at least the damage may be much lesser. So that's my broad view, that it's a tough view, and you have actually enumerated a lot of the risks which are there: global interest rates, inflation. The list goes on, and plus the fact that markets have actually rallied very smartly in the last 2 years. So I think it will need a breather. We don't know the exact reasons. Some of it are playing out right now. So it's better to be safe right now. That's my view. I'm sure others will have different views. That's how we are constructing our portfolio for 22.
So what are you doing with your portfolio? I mean, when you say constructing your portfolio, where are you taking chips off the table? Where are you moving from high growth to value, or from less risk to more defensive? How is that approach working out? How are you playing that?
Yeah, so we've been doing that over the last 6-8 months. Moving more to value, especially say in the financial space. I mean, I have mentioned this many times that we've been very long PSU banks, and look at their performance in the last 1 year. Hands down, they've beaten private sector banks. Not to say that we are bearish on the private sector banks. We have a fairly significant exposure in the top 3-4 private sector banks, but we have significantly upped our exposure in the PSU bank. So, and at the cost of say NBFCs or some of the higher risky part of the financial basket. So that's one way of doing it. The other thing is, wherever there is high growth and high expectation, we are trying to, or we have already taken the profits and shifted to stocks where the earnings are slightly better. Metals is one name where we are very bullish on non-ferrous in particular. And the list goes on. So, I mean, in every sector, you find something or the other where you can mitigate your risk. But not to say that if the markets were to have a sharp correction, these will hold. But possibly they will hold slightly better than many of the other stocks.
Good morning, Nantara here. So you've told us the kind of sectors you're buying into, non-ferrous metals, for example. You're increasing your holdings when it comes to the public sector banks as well. What about IT? We've seen the IT stocks come off considerably from their lifetime highs.
Yeah, so again, IT is a sector where you have to be very stock specific. We cannot, broad base. As we are seeing, there's divergence in performance between, stocks itself. I would be underweight IT, but we would be specifically overweight in certain stocks where we think that the earnings visibility is very strong. Keep in mind that IT in general has been a bit cyclical. If you take 10-year performance of IT, it isn't as secular as it was in the past. So you have to, play this according to the cycle and how the valuations of the stocks are playing out. So I think that's the broad view I can give, that we are broadly underweight IT, but stock specific where we think there are strong earnings momentum, we would be long.
Okay. So would that be the blue chips over the mid-cap IT space? And if you could tell us that, and also autos. We had seen autos make a move towards the end of last year, the big deal by Tata Motors, which had a rub-off effect. How would you also approach that space now?
Yeah, so on the IT, it's a mix of broad, large cap and a mid cap. And on the autos, I would have to split the autos into, say, two-wheeler, passenger vehicle, and commercial vehicle, and possibly even tractors. So two-wheeler, we are significantly underweight. We think that there is a slowdown in rural India, plus the fact that in India, we think that when EVs actually play out, it will be the two-wheelers which will first be off the block. It will take some time for passenger vehicle and for the other EVs to play out in the market because of the charging infrastructure. For a two-wheeler, it's very easy. You can charge at home. So we think even some of those fears are playing out. People are deferring their purchases because there is a lot of buzz about EV scooters in particular. So that's a segment we are very light on right now. The commercial vehicle part looks very interesting because we are seeing increased CAPEX by the government. We are seeing demand picking up. There'll be some lull in between because of some of the COVID related issues, but in general we think that's a space which looks interesting. And on passenger vehicle, again, we are seeing issues with respect to supply. So I think those supply issues will take some time before it gets sorted out. So that again is, so if you ask me, the commercial vehicle looks the best in the auto right now, and that's where we would be putting our bets.
Sridhar, hi, good morning. Avan joining in. The big news this morning, apart from global headlines, is that LIC has filed its papers and now we're set for the biggest Indian IPO ever. I wanted to understand your thoughts on this from the divestment standpoint, because this is set to garner between 62 to 65,000 crore rupees, helping to achieve the divestment target, which has been lowered, of course, time and again. How are you looking at, the overall divestment target now being achieved basis what was announced in the budget, and what this means potentially for some of the other PSU and divestment candidates in the pipeline?
So I think this is very positive from a government standpoint that they are sticking to their commitment, even though they have reduced the divestment target. They've been more transparent in the last 2 years, and I think most market participants and commentators have accepted that the transparency as far as the budget and the outlook has significantly improved. And I think the fact that they were committed to doing the LIC IPO this year, and the fact that they have now filed the DRHP, this augurs very well from their credibility standpoint. We will see how the market reacts to it and what sort of valuations these come. We just got the embedded value details. More details are still awaited. And this is a sector where there has been reasonable interest given the penetration story and stuff like that. But some of the private sector players, the valuations have actually got very stretched, and we have seen some of them underperforming. So this may be another PSU versus private bank story where, if the valuations is good, people may want to, look at, this IPO versus their exposure in the overall life insurance scheme. So this I think is fairly a positive news as far as I'm concerned, and it also gives credibility to the fiscal deficit number that the government has put out.
Fair enough. And, we're getting toward the fag end of the earnings season. 46 out of 50 Nifty companies have already detailed their quarterly show. And as per our latest scorecard, majority have been above what the street was penciling in. Given the fact that we have already seen India Inc.'s PAT to GDP ratio inching upwards, the overall, PAT growth on a free float basis has been quite robust on a year-on-year basis at 23%. How are you looking at the kind of earnings trajectory that we've witnessed so far, and any specific sectors that stand out?
So I think as far as earnings is concerned, there is a general belief that January has been very soft thanks to Omicron. I myself have been traveling extensively last month, and most places, malls and other places of tourist interest were literally empty. So I think, and the feedback we are getting on the ground is that Jan has been very soft. So I think we'll have to keep that also in mind, that we saw a reasonably good quarter as far as the December quarter is concerned, but we could see a soft quarter. But having said that, I think a lot of it is already priced in. Also, if you bifurcate the earnings, you will see that many of the companies are facing EBITDA margin pressure because of the way how commodity prices have moved. So the earnings surprises to a large extent have also come from the financial space, where we believe that the provisioning numbers over the next 18 months would significantly come down, and private sector banks and PSUs in particular will significantly benefit, and their earnings numbers will look very strong. Commodities, the other segment, obviously the way commodity prices have moved, they've showed very strong earnings trajectory. So I think it's been a mixed bag. On an overall basis, we've done well, but there have been a lot of misses in between because of the commodity prices and the cost pressures that companies are seeing in particular.
So Sridhar, when you say it's time to protect capital, stay on defensives, is it time to sit on unusually high amount of cash? That's what we're trying to understand. That look, one is that you say, I'm going to move out of a high growth stock into a value stock, but you're not reducing your exposure to equities. Are you saying that sit on 15% cash, 20% cash, because it could be a bad year like 2008 or a bad year like what we saw, let's say in 2008 was an outlier, but let's say like 2013 or 14?
So Nikunj, as a house and as a family office, we have the freedom to do what you're saying. And we are sitting on some amount of cash, which is higher than normal. But for most fund houses, that may be a difficult proposition. And I've been on the other side, and I know that it's not easy to sit on 15% cash. You'll have to answer too many questions. So I think the best way for people who have benchmark and peer group is to go into defensives. But we as a house or an individual can easily go into a little bit of higher cash. But if somebody is in a SIP environment, then this is how the costing gets averaged, that you invest over a period of time, then you get the ups and the downs, and over a period you start making money. But as a house with large exposures in the market, there are tactical changes that you make to your portfolios, and the signs for this were there since October, November. I mean, it isn't as if a lot of the headwinds that we are talking about is new and it has cropped up just suddenly. It's very much been there. So the market's given chance to people who want to take a different view, enough opportunity to move to a different portfolio strategy or to go into cash.
Now, when you say you like IT companies, the ones which are growing, I'm just thinking which are the IT companies which are not growing, because everything in IT is growing.
So Nikunj, we'll have to see the growth with respect to the valuation, right? So if companies are growing at, say, low single digit, or the outlook is that they may grow at low double digit, and the outlook is that they may continue to grow at low double digit, versus a company which is showing, say, a strong double-digit growth, say in the teens or higher teens. I mean, that's how I would differentiate. I mean, it's end of the day a call whether the growth will continue or not. What sort of digital revenues these companies are having? What is the segment of BFSI versus some of the others? So I think it's a bit more detailed. It's very difficult to pinpoint. But yes, some of the large caps have done well. Some of the mid caps are also growing very fast.
One of the sectors which you've liked as a house is telecom.
Yes.
And given what is happening to the telecom tariff, consolidation is happening. This is one sector where macros will not change. Or this is one sector where high oil prices will not affect your consumption patterns. Or COVID is not going to change the way how we would be consuming minutes and data. Are you still bullish on telecom?
Yes. So thanks for asking this question. So I missed on telecom. So this is one of the segments where we are extremely bullish, and you put out exactly the reasons why we should be bullish. But I'll just put a perspective on the numbers. If you look at the mobility revenues 5 years back, the industry was clocking about 2 lakh crores, roughly. I mean, give and take a few thousand crores here and there. If I annualize the last 4 quarters, we are at roughly 150 to 160,000 crores. And if you take the last 5 years, for the telecom company and for the customer, the data volumes that we are consuming is up at least, say, 50 to 100 times. The minutes of usage have gone up by about, say, 15-20%. And in general, the other fringe freebies that we start to get, say, usage of some of the OTT apps and stuff like that, doesn't warrant the fact that the industry has actually lost 40,000 crores of revenue during the period. And we know why. There's been ultra high competition from one particular player. We think that as this normalizes, this 40,000 crore, which comes back to the industry, maybe in the next 2-3 quarters, gets significantly distributed between maybe the top 2 players. We just have 2.5 players left now. And it is up to your guess to figure out how you want to, give valuation for some of these. We think that a 200 rupee ARPU we would see very soon. And once we see some traction on ARPU, this is a segment where we think that, as you mentioned, that it is insulated to COVID or some geopolitical issues. And if I look at valuations for the segment, it looks reasonably, in the average right now. It's not at any point we can say that it's the higher end of the bracket. So we remain extremely bullish on this segment. We think this is one of the segments where we could use to protect capital and to also make some money.